If you're new to investing and you're trying to figure out where to actually put your money, index funds are one of the simplest, safest, and smartest ways to start building wealth. But here's the problem. There are hundreds of index funds out there. Some are great. Some are expensive. And some look safe, but silently eat your returns. So in this video, I'm going to give you a simple breakdown of the best index funds for beginners, how to invest in them, and a few tips you absolutely need to know before you start. Stick around to the end because I'll walk you through a 3-step beginner investing plan anyone can follow, even if you only have $50 to start. Let's get into it. What is an index fund? Before choosing the best index funds, let's quickly explain what an index fund actually is. An index fund is a basket of stocks that tracks a specific part of the market. For example, the S&P 500 index tracks 500 of the biggest U.S. companies. The total stock market index tracks almost every publicly traded company in the country. A NASDAQ-focused index tracks tech companies. Instead of betting on a single stock like Apple or Tesla, an index fund lets you buy hundreds or even thousands of companies at once. This gives you instant diversification, lower risk than picking individual stocks, very low fees, solid long-term performance. Warren Buffett has even said that for most people, a low-cost S&P 500 index fund is the best investment they can make. Now that you understand the basics, let's go through the best ones beginners should start with. The best index funds for beginners. We'll keep this super simple. No complicated charts, just the funds that work. 1 S&P 500 index fund, beginner-friendly, strong long-term performance. Examples: VO Vanguard, Fidelity, Schwab. If you only chose one index fund to invest in, the S&P 500 would be the easiest choice. It holds 500 of the biggest companies in the US, companies like Apple, Amazon, Microsoft, and Google. It's simple, diversified, and historically returns around 7 to 10% per year after inflation over the long term. Why beginners love it? Easy to understand. Low fees. Competitive long-term returns. This can literally be a one-fund portfolio. 2 total stock market index fund for maximum diversification. Example: VTI, FSK, ISX. This is like the S&P 500, but bigger. Instead of 500 companies, a total stock market fund includes 4,000 plus companies, including small and mid-cap stocks you wouldn't normally buy individually. Why you might choose this instead of the S&P 500. Even more diversified. Captures growth from smaller companies. Same super low fees. Many investors use this as their core holding. 3 total international index fund, optional but helpful. Examples: VXUS, Fidelity. SWAGs. If you want exposure to companies outside the US, like Samsung, Toyota, Nestle, or global emerging markets, this fund covers the entire world. Some people skip international funds because US companies already operate globally. But it's still a good option if you want even broader diversification. For NASDAQ 100 Index Fund, higher growth, more tech-focused. Examples: Fidelity. This is the most growth-heavy fund on the list. It's packed with tech companies, so it tends to grow faster, but also swings more in price. Not a core holding for beginners, but great as a small growth portion of your portfolio. 5. Total Bond Market Index Fund for stability and lower risk. Examples: Vanguard. Fidelity. If you want to lower risk, especially as you get older, or want quieter returns, bond index funds are a great stabilizer. Bonds won't grow like stocks, but they smooth out the bumps. How to actually invest in these index funds. All right, so you know which funds are great. Here's the simple step-by-step guide. Step 1. Pick a brokerage. Beginners usually choose Vanguard, Fidelity, Charles Schwab, Robinhood, SoFi for mobile investing. They all offer zero commission trading and low fees. Step 2. Choose the fund. Example beginner portfolios. Option A, super simple, one fund. 100% S&P 500 or 100% total stock market. Option B, balanced two funds. 80% S&P 500 or total market and 20% international. Option C, very safe with bonds. 60% total stock market, 30% international, 10% bonds. Step 3. Set up automatic investments. This is the secret. Most people fail at investing because they try to time the market. Instead, set up auto-investing weekly or monthly. 20-week. 50-month. $200 a month. Whatever you can do, just be consistent. Step 4. Leave it alone. Index fund investing works because you don't touch it. You're not trading. You're not timing the market. You're allowing compound interest to do its job. If you found this helpful, hit the like button and subscribe for more.